Welcome to Idaho AgBiz Insights. I'm Brett Wilder. My colleague Colby Field and I are area extension educators with the University of Idaho. We'll be the hosts of this program today.
Hello, everybody. Thanks for joining us. For a while now, we've wanted to establish a platform to better share important programs and topics impacting Idaho farmers and ranchers as they happen. And so this AgBiz Insights series was born. We're fortunate to have great industry partners to collaborate with and are willing to share their knowledge. And this is the platform where we'll bring you those people to have pointed discussions and give you an opportunity to have your questions answered. The format of this series is intended to be mostly conversational. However, most topics will require context. We ask our guests to bring charts or slides that they feel are necessary for understanding their topics. We want to make sure everyone gets the most out of this experience. So please type your questions into the chat or the Q&A section on your screen, and we'll make sure that those questions are covered today.
We'd really like to thank Dustin Winston. He's a commodity market analyst with StoneX Group for joining us as our first guest. Dustin's an Idaho native. He has a Master's of Science in Applied Economics and a Bachelor's of Science in Finance and in Agricultural Economics, all from the University of Idaho. After gaining a passion for commodities, Dustin focused his efforts on the dairy industry, where he has been involved for the last 7 years. Since joining StoneX in 2019, Dustin has served as a commodity market analyst, providing quality market intelligence materials in the dairy and livestock markets. Over the last 5 years, Dustin has worked directly with many agricultural organizations, including publishing for Idaho Dairymen's, Ag Proud, and Cheese Market News. He also works with us to help educate students at the University of Idaho about dairy markets and the tools used to manage risk from production through processing to sales. So the big topic of the day is livestock risk protection insurance. Dustin, can you take it from here?
Yeah, thanks, Brett and Colby, for having me. Excited to be on here and lucky enough to be on the first edition of this AgBiz Insights. I think it's a fantastic program and a really great platform for Idaho producers, stakeholders in the agriculture industry to get involved and stay up to date. So I appreciate it. As Brett mentioned a little bit about myself, since that bio was given to him, a couple of years ago, I realized that I have not adjusted that to show the amount of beef impact that our business has grown, particularly here in the Northwest. And a big part of that is because of this program, LRP, or Livestock Risk Protection. There's a great combination between the amount that it supports both our beef producers and our dairy producers, and the overarching cattle industry here in the state of Idaho and in all 50 states, really. So excited to be on here and share a little bit about that and the adjustments that were made this last July, so only 2 months ago now, to the benefits of these producers. Most of those really held on the dairy side with this new evolution of crossbred dairy and beef cattle. But there's benefits to every producer with a four-legged animal that moves out there in the state. Really, it's important in any conversation. I am a licensed agent of LRP, so able to talk about that, and that's the first step anybody should ask and when they want to have a conversation about LRP. But important to understand what it gives you. So first and foremost, this is a USDA-backed product. They subsidize a part of the premium, and that's a really, really big benefit to what we would consider conventional risk management strategies we would have employed at a company like StoneX or any other risk management agency. Really, we've now stepped away and grown from what we could use in just being futures and options. What this allowed us by the USDA starting this was 1, flexible timing, 2, flexible coverage, and 3, it's not listed as a bullet point here, but flexible amount. So what do I mean by amount? You can insure as few as 1 head, which is a big difference from the feeder cattle and fat cattle futures on the CME, where it's 40 or 50,000 pounds, depending on the contract you're talking about. So that's a lot of animals. And we're now here to a product that can benefit anyone from somebody that's got 10 steers that they're raising for beef, or 1,000 head operation. So really just a significant bonus there. And considering this program is only 7 years old, it's been fantastic to see these things work out for folks. And now we're in this time period of the highest beef prices we've ever had, which is even more of a reason for us to be talking about this today. And I think what led to, I would guess, you guys having me on for this first one, and the fact that we're pushing quite literally the highest prices we've ever seen. And this program offers the ability for producers here in the state to lock that in for up to 52 weeks. And so to me, being a proponent of risk management, I think it's a no-brainer. I look at products like this and think of it in terms of the goal. I hate saying it, but the goal should be to lose when you put on insurance. Think of it like car insurance. You're not hoping to go get in a car wreck, but it's there in case you do. And so that's the same mentality I have around programs like LRP. You're not hoping the price falls. I hope that beef producers and dairy producers that are utilizing this program get to stay in business and keep benefiting from these prices. But it's there to protect when needed. And in the dairy space, very much needed right now with prices falling. So there's my first little bit. I'll pause here because I tend to be a motor mouth, and see if there's any questions from you guys.
Yeah, Dustin, this is fantastic. I know it's been a great program and a game changer. Here at All Time Highs, are you seeing more adoption of LRP, or are you seeing less adoption with people having kind of a fear of missing out of those all-time high prices and not wanting to give up $20 a hundredweight to do it?
Yeah, that's a great question. From my perspective, most definitely more adoption. So you kind of got to break it down into the two segments that use this, right? There's many different coverage types, and they were built around the fact that both dairymen and cattlemen have exposure to the markets, but they're in a little bit different ways. So for our dairy side of things, the interest and adoption of this has exponentially grown, particularly in just the last quarter because of this decline we've seen in the dairy markets. And so they're really leaning on these high prices of beef dairy cross calves that they're getting. And at the same time, that was one of the new additions we had in July, is this beef dairy cross calf. So just in the last 2 months, you've had the ability to benefit from this, a more tangible or one-to-one um, uh, uh, analysis of the product between what they can cover and what they've got, if you will, that they're really leaning into. And then on the beef side, I think a lot of the conversations I have here center around, you know what, to lock that in, a price that I've never seen before. I mean, you're talking 330 potentially out 52 weeks, depending on what you're covering, for a guy to lock in after the premium is taken out. That's assuming that's your floor price for a place in which we don't know what next year looks like. And that's the whole reason why we look at risk management. Why wouldn't you at least place that and then know that you've got that baked in, hope that we go up to 4, right? That's the conversations I'm having here.
Awesome. When you mentioned that for 2 months now, we've been able to use buy LRP on beef and dairy cross calves.
Mhm.
What can you talk a little bit more about the other new program?
Yeah, so the beef dairy cross calf was one addition this year. Also, as far as products they added a coal cow contract. This one is a little bit interesting because it doesn't fit the same time frame that they have for everything else. They only allow a 13-week contract for coal cows, but in particularly for dairy, this has been a big thing because they know most of the time how many cows they're going to be culling in a given month, and so you're able to place that, and most guys are doing that on a rolling 13-week basis right now that we're chatting with. And again, I think short term, most of their perspective is, I doubt we'll see a decline. Most guys are looking out right now to next year as we approach the summer, and maybe a pain point economically there. But they're still putting on that coverage as a just in case. That's the whole conversation. The one other addition that they made in LRP and DRP programs was expanding the beginning farmer time frame that they have. So previously in LRP or DRP, if you had been in the industry less than 5 years, you could sign up as a beginning farmer and get an additional subsidy from the USDA. They expanded that to 10 years this year, so you can get up to an additional 10% or 10% to 15%, excuse me, depending on what time frame you fall in, on top of the normal subsidy. So that's been really great, especially as I see a few more young folks in our Idaho agricultural industry, and those seem to be the ones, from my perspective, that are actually looking at buying animals right now.
Dustin, we've got a question from the audience, and it starts with a statement. LRP has historically been difficult to purchase, much like buying tickets to a concert. High demand for LRP would often shut down sales for the day. The question is, has RMA increased the allowed exposure level?
Yeah. So to my knowledge, there is no cap on the amount of producers that can place coverage in a single day. The current caps are the amount of animals that you can cover in one time period, which we can jump into that in a little bit. We'll cover that in my pro con slide I put together. And then the second one is if a market moves limit. And so what that means is if we push the threshold on futures to a price that the CME has set, that it is the maximum amount of price moved in that day, they will not issue prices. But outside of that, if we have prices issued, I could have every single one of the producers we work with at StoneX cover that day. So no cap there as far as the availability to get coverage if prices are issued anymore.
Awesome. Well, fantastic. Well, Dustin, I know something that you and I have talked about a lot. It's really been a mind blower for me is what really is with these whole-time beef prices. I know we're going to talk about dairy a lot, this unborn beef dairy cross program. What's it worth for these guys right now in terms of that beef on dairy cross?
Great question. Great question, Brett. So right now, we did an analysis this week, and we've kind of been doing a rolling analysis. Of course, this coverage only existed for the last 2 months. But if we take the model that this coverage is built around and we roll that back based on the CME feeder kettle index, going back to 2016, you can see in the gold and blue lines there the amount of value for what that calf would have been worth, a beef dairy cross calf, and what it is worth in a milk price equivalent. So right now we're looking at over $1,400, almost $1,500 per calf, and just over $3.50 additional revenue to the milk in terms of milk check dollars on a 100-weight basis, which is posing a brand new thing in my 7 years involved in the dairy industry that I've never seen. And that's folks taking a look at animals they would have previously culled that maybe their production has come off a little bit, but if they're able to still hit windows and get that cow pregnant, they'll carry a calf in that cull cow just to get the paycheck for the calf right now. And so when we're talking current price of dairy for class 3 is settled today at $16 for the rest of the under $16.50 under 17 out through the first quarter of next year. That's a big impact to what most folks are probably sitting at between a 16 to 18, depending on the size of the dairy, break even. So when we're talking about being very close to break even numbers and then having that $3.50, it's no longer the fun money or the budget for vacation or whatever the calf prices used to be. It is a significant cash flow on the operation these days. And so even more impactful that we now have this contract that we can bake that in and really manage that volatility and that risk.
Wow. That's fantastic, Dustin. You said the average break even is probably $16 to $18 a hundredweight right now. I know the main topic of this conversation is going to be LRP, but can you talk a little bit about DRP and explain what that is? And then would you recommend for producers that they look at using both of those tools? And in theory, could we use both of those things to lock in a above break even milk check right now?
Yes, 100%. So quick little overview on DRP here. The way DRP works is rather than covering for a specific time period, it's like LRP, you would cover cattle that are going to be marketed in May or June or July. You cover a quarter of milk at a time. Um, the nice thing about both programs is the volume, the coverage level, all of those things completely selectable by the producers. So we have folks going from various coverage levels depending on how much premium they want to pay, and most of that's just to look at what's the premium versus the value you can cover, and where do I want that floor price set. So right now we're still able to look at a pretty decent DRP price. The maximum coverage there is 95%. So if we look at like Q2 of this year, we just got prices out. So bear with me for a second while they load up, but I'll continue to talk while we go through that. We're having conversations very much right now around covering with both to manage that margin and manage where these folks are locking in. So right now you can cover out at about 16 after the premium. So that would be your absolute worst floor price. And we're having guys still consider that just because we have so much milk right now in the country, and we don't know what that's going to look like. So for these dairy guys in particular, we're rolling out all the way 52 weeks with most of these unborn calves every single time we get a new month, and they've got coverage on bacon in just to make sure that they're going to break even on milk and then take the advantage of these calf prices.
Fantastic.
Did that answer your question, Brett?
Yes, it did.
Do we have any more from the audience, Colby?
Nothing currently.
Okay, sounds good. Well, happy to chat about a little bit about what we used to have versus what we have now, if you guys are good with that. Awesome. So we still most definitely have futures and options, and I'm going to start this slide with saying a lot of folks use use these two tools now in combination. So the greatest thing, in my opinion, that both DRP and LRP did was get producers that maybe had concerns about wrapping their head around futures and options. And that was simply because they had so much other stuff going on and running their operations. It allowed them an easy way to enter risk management. And now we have folks getting familiar with these topics and utilizing both, because LRP and DRP are really just subsidized puts when you break them down. And if you're not familiar with that, it's just subsidized way to set a floor price for at a premium cost, just like the insurance analogy we used earlier. So previously we just had futures and options to utilize. That was before 2018 when these products were launched. They did have quite a few pros. You had a lot of flexibility. That's the major one. You can get in and out of futures and options every single day if you want to. Wouldn't encourage it from a hedging point of view, but you have the ability to move and manage that position is essentially what I'm getting at here. But it did come at the cost of potential upfront cash and a very large contract. We already talked about that, 40 to 50,000 pounds, depending on what type of cattle you're talking about. What LRP brought into the offering was the ability to hedge most of your cattle. You can hedge up to 25,000 head per year. You get to pick the weight. You get to pick when you're going to market them. You can actually even retain the animals you cover, so you can place coverage on them. And then rather than taking them to the sale yard, if you want to keep feeding them out once they hit that date, you can just get your vet to say, yep, they're still on the farm, and we submit that to the insurance company. So really, really good advantages there. But the biggest one in my mind is the cash efficiency. All of the premium is due after the marketing date that you've selected. So you're getting paid on those animals before you have to pay the insurance. Whereas with futures and options, you have to pay up front. The con is there's less flexibility, and that's really why we have folks that utilize both, particularly in the dairy space where there's a little bit more movement. But I've seen a lot of savvy cattlemen really utilize this to work up their break-even price of LRP even further, or reduce their premium costs. And you can use options in both of those ways. Any questions on the pros, cons? Anything you guys think that I should dive more into here or might have been confusing?
Dustin, could you clarify for me a little bit more of the advantage of using these different tools in concert? Because I didn't fully grasp that.
Of course. So a lot of times we'll have folks utilize LRP in conjunction, particularly with options. You add on futures, it really does inherently actually add risk rather than mitigating it. So we'll use options because it still has that ability to mitigate risk. And we'll either sell options at a time period somewhat close. We can't do it on the same day, but you can do it somewhat close to cheapen up that premium because that option, by selling that option, you're getting some premium back. And so we look at those as essentially a break even just between a spread. And then the other one is they'll potentially look at further coverage layering in. So they won't cover all of their animals at once. What they'll do is they'll put in a floor with this subsidized LRP, and then they'll wait for opportunities to start layering in other options to raise that floor price. And so they'll take advantage of some subsidy, or some folks will just do that simply with LRP too, where they'll layer in for a specific time period, but they'll do it 4 or 5 months. So if you would have done this in cattle over the last 4 or 5 months, you'd have been raising that price and just taking 20% increments or so. So there's a lot of strategies, and that's something, whether you are currently a utilizer of LRP or DRP, any insurance product, risk management, talk to your broker, talk to your insurance agent. The benefit at StoneX is we can be both, but there's plenty of really great shops out there to go to have this conversation. And many folks, especially in cattle, have actually had policies for some time, but until this year didn't use them a whole lot. And that's simply a case of it takes a long time to grow a steer. So locking yourself into a price is a little bit less advantageous, and that's why we see so much utilization in a revolving utilization in dairy, but still a lot of really great opportunity. And if you can do that right with conventional, what I'll call conventional risk management tools and futures and options, LRP, potentially even taking a look at your feed side, you can really bake in a margin, and that's the whole goal, to know that you're going to be profitable, right? So there's pros and cons to both, but at the end of the day, we want to look at this from, I got a whole toolbox to utilize, and we got to bring out every wrench and drill to keep ag producers in the state going.
Thank you.
Dustin, before we move on, the other thing that I really think about with the difference between these programs is how much smaller the basis risk is.
Mm-hmm.
Can you talk a little bit about, especially with the new programs, just how much better we can do hedging compared to what we had before, and kind of what are the price indexes that we're using to hedge these cull cows and to hedge these unborn dairy cows?
Yeah, we still will have some inherent basis, particularly speaking about the producers that we serve, you both and myself in the Northwest, because most of these play back to the 5 state average, um, with their prices. And I'm gonna jump to what I think is the next slide. Yep. So that actually shows us some prices here. I threw up two, and these were from yesterday. So if you're watching after the fact, these prices come from September 24th. But what we were able to grab here, or yep, September 24th. Yep. So what we can see, and this might be a little bit of a roundabout way to answer your question, Brett. So check back with me if I didn't get to it all the way. But in the bottom picture that I'm showing there, that is coverage on unborn steers and heifers, so full beef animals, to be sold in September. And what that last column that's highlighted in green numbers is showing is the subsidy value of what you would pay on an option in the futures market versus what the premium difference is that the producer would be charged. So getting anywhere between $7 to $5 per hundredweight in subsidy value back, discounted on your premium, depending on which coverage level you pick there. Now, you mentioned where are these prices relating from. So every single one of these is built slightly different. For example, our unborn dairy beef cross animals, those are on a 395% relationship to the feeder cattle index. And that is a moving number. Same thing with so that's just today, what they are at. Same thing with coal cows. We talked about that as a new one. So that's on a not fixed coefficient. It's a revolving coefficient. We'll always be able to say, and the agent should be able to tell you where that number is. And most of the time for coal cows, it's about half of the price index there. But all of these are based on the current market tools and have extensive research that was done on what the US price averaged out looks like versus where these tradable products that we have in the futures and options market are, and what the coefficients should be, what the correlations are, making sure there's best fit. So these programs, I mean, they wouldn't exist if they weren't built to succeed and built to match the industry. And knowing the person that has built most of these, speaking with a lot of the folks within this program and getting as involved as we have at StoneX, I'm very confident in the continual lifetime of this and how it matches up against prices. Again, we will still have a basis slightly. So these prices are not based on what a single producer's check might be at the sale yard, but based on where the index settles at the time they decide to market.
Just to make sure I understand, both of the new products back to the CME feeder cattle index
Correct.
and the coefficient, what the multiple is, will change and adjust based on changes in the spreads between the feeder cattle index and some other index of how cull cow prices or day-old calf prices are moving.
Exactly correct. Yep. It's a little odd. Most people, I'm going to take this moment to clarify the cull cow one. Most people would go, wait, cull cows relating to a feeder cattle index. That's a fat animal. That's a live animal. Yes, you would be correct in saying that. However, when the correlation was done, there was about a 4% additional benefit to tracking with the feeder cattle index than the live cattle futures. And so that was why the feeder cattle index won out over the live cattle futures. Both are over 90%, but I think it came out somewhere to 98 versus 94. And so just slightly a better fit.
Awesome. And then maybe this is in one of your other examples, but just for those on the call or those who may watch this later that are a little less familiar with basis and how that works, can you just kind of walk us step by step of what the differences can be for a producer when they actually settle this thing out and what the index is and how that plays out?
Yeah, you want to take a look at an example here of like place and coverage? Is that what you mean?
Let's do that.
Awesome. Okay. So let's say right now we're looking at covering unborn calves that'll calve in March and we want to sell them at weaning. So roughly just under a 6-weight calf that we're planning on selling at weaning there in September. Rough time frame. Sound good? Okay. So right now, if we are to go all 52 weeks out, to our best coverage, so that calf is in utero, going to be calved in March, we can lock that price in for 356.37 a hundredweight right now. And again, that's applied, so you could pick 5.5 weights. If you're over, there's no penalty. You just wouldn't get that little bit of extra coverage. And for the unborn calves, it is 0 to 599. So I did this at 5.5 weights, assuming that if you're a little bit under, then if they just take the percentage that you're under on average weight versus the price you covered at. So let's assume we get those calves to 5.5 weights by September. We want to cover it 100%. So that means our coverage level is 356.37 per hundredweight. And the premium, as we showed, was 20.79 per hundredweight. So that gives you a break-even price or a absolute floor price of $335.58 on your LRP coverage, right? So there's your minimum price there. Didn't know I had slide transitions. Sorry about that. So now let's take a look. Say we get to September, right? We're in September of 2026. And really quick, I'll just take a note. I had you pulled up a previous slide deck around this time that I was building it, and we had prices $100 per hundredweight less at this time last year. So crazy good opportunity where we're at right now. And again, this is just about making sure you know what you're going to get. You can still participate in the higher values, which is a really nice thing because you're only locked into that premium cost. So let's say the index, again, not necessarily your sale price at the sale barn, but the index finishes above 356.37. That's after the coefficient is applied, of course. Then no indemnity, no check will be written to the producer. The full premium will be due. And producers actually, they just expanded this. So it went from 60 days to 90 days after the end date for payment. So you actually have an additional quarter to still pay that after the marketing of that animal. So pretty cool deal there. If we end up between 356.37 and 335.58, so somewhere in between that level, that premium level, no indemnity will be issued, or there will be an indemnity issued, but you won't get a check for it because that'll just be deducted from the premium that you owe. So maybe we end up right in the middle and you end up owing $10 per hundredweight instead of 20. So great, cool. You're still protected both ways. And then if we end up below that, so say, like I've heard a few people talk about, economics look like maybe a concern. Some restaurants aren't even putting steaks in the beef aisle anymore because it's so expensive and people aren't interested in buying it. Prices typically go up during grilling season, so will a consumer be willing to face that price? I get a little worried about where we might be come next May. So maybe prices fall below this level and we end up below 335.58. Then no premium will be due and you'll get an indemnity for the difference below 335.58 that you are. So a producer would get a check for that amount. So really great opportunity. In the Northwest, we actually have the advantage of typically seeing a little bit of a basis on top of the 5-area average. So that is also to our benefit here. Whereas some of those folks that are in Oklahoma or Colorado or Nebraska, that are closer to that, aren't actually going to see that benefit. So because of that, you could get a better price in the sale barn and still get an indemnity. I haven't seen that happen a ton, but it is doable. So all signs point to fantastic product for Northwest beef producers and dairy producers to be utilizing.
Wow. That definitely seems like a fantastic program. So just start to finish, pretend I've never heard of this before, new producer, taking a look at this. Am I able to, what is the precursor that needs to be hit for me to actually enter into a policy?
Yeah, great question. So you got to talk to a licensed agent. Again, StoneX, we have a few, I'm one, but there's multiple groups out there. So got to go to one of them and say, hey, I'm interested in LRP or DRP or whatever insurance product. There's quite a few out there these days. Rain and hail, all those things. Not everyone carries the same or is able to provide to you the same product. So like at StoneX, we only have LRP and DRP. So you could come to us if you were interested in that. The paperwork is so easy. If you're a sole proprietorship or an LLC, all you have to do is show up and say, hey, I'm interested in signing a policy. If you've never done it before, you can do it at any time. We need your name, address, the basic stuff that you're going to give to any bank or anything like that. A couple of private details about you that obviously we're not going to share. And then we send over a document that you sign online. Super straightforward. If you have had a policy, but you're looking to transfer to someone else, maybe you're like, oh, I know someone who just got hired over here. Maybe they have a better tool to offer because, again, it's a USDA product. So all the prices are the same no matter where you go. Then you do have to wait until June, even if you don't have anything covered, to change that policy. You can do the paperwork at any time, but it won't roll through until June. So once that's done, typically takes 24 to 48 hours. It's pretty quick to get that policy through, and then you can write an endorsement at any time. And again, we get prices almost every afternoon, unless there's a extreme market move, or in the case of dairy, there's a market report that comes out that day. So we wouldn't get prices then, but you're talking maybe 5% of the days of a year that we're not getting prices. So a lot of opportunity. And then from that point, it becomes a conversation between the agent and the producer about how active you want to be. And for everyone, it's a little bit different. But the couple of things that I would really encourage is know what your break even is, at least have a rough idea. I know, particularly in cow-calf operations, I came from working them. Sometimes the break even is a little hard to figure, but have a rough idea on what your animals are worth, what you need to be getting for them to keep the operation going, keep the doors open. And then at that point, just have a conversation. We've got a lot of folks that are far more interested in trying to get the best price. That is not how I would recommend looking at a risk management strategy, but I'm not here to tell someone how to run their business. We're here to just help facilitate the usage of these tools. So you can do that, or we have guys that are covering the same amount of animals every single month, and they're legging into that, or they're covering every quarter, just whatever the price is at the end of the quarter. So it's just a conversation that needs to be had. But once you've got a policy, it is in perpetuity, meaning it doesn't cancel until you choose to cancel it. It continues to roll, and it's $0 to have any policy with anyone. If somebody's charging you to hold a policy, go somewhere else.
Gotcha. Going into this a little further too. So the unborn calf policy, do you have to have a cow that's confirmed bred to enter that policy? Is that how that works?
Great question. You are supposed to have the animal bred.
So there is no.
That said, there is no requirement to show a vet check. Nothing like that.
Gotcha.
Also, death loss. Death loss is a pretty common question we get, so we'll tackle that here real quick. If death loss occurs, obviously we don't want to be paying for an animal that died. LRP unfortunately does not cover animals that die, but we can take them off the coverage so that you're not getting charged potential premium on an animal that is no longer on your property. So that one, we just have to be alerted within 72 hours of the time the producer finds the animal. So even if they're out on the range and you don't, maybe they're 2 weeks old dead, but you just found them, you call me or whoever your agent is up, and we just take that off your policy. We file a little addendum. It's super easy. The other big question we get is, and I alluded to this a little bit, but we'll say it one more time, is retained animals. So right now we're having a lot of conversations with guys going, I don't know if I want to sell them at 6 weights. Maybe I'll keep them in the background of myself. Feed's really cheap right now. You can retain animals under this coverage, and they still be covered. So if the index falls below, let's say you've got an unborn calf and you don't know if you're going to make that decision, but you want to have coverage on it. And we get to that September example that we worked with. Market moved lower, and you're like, you know what? Market moved lower, but I still have a great margin on this animal. I still see the valuable opportunity to keep it. Well, you can still get an indemnity on that coverage and then choose to roll that into another set of coverage on the animal or not. That's totally up to you. So we have a lot of folks, particularly backgrounders and cow-calf backgrounders and some feedlots that are multi-covering animals. You can't cover the animal at the same time, but covering it in different stages of its life.
Gotcha. And in theory, you would pay the premium on each stage then?
Correct. So yeah, if you went from an unborn and then covered it again at like a 6 before it hit a 10 weight, and then feeder cattle. So we've had folks cover at all three stages that the LRP offers.
And just for sake of conversation, what would be the total cost of premium per head in a situation like that?
Oh, great question. It changes a fair amount, but if I had to do some back of the napkin math here, you'd probably, I mean, like right now, if you'd been rolling all that coverage, you're probably looking at max $400 to be covering the finished animal.
Okay.
If you've got another question, I'll multitask here and pull up all three, and I'll get you an actual number.
I think this is a great opportunity to reiterate for our attendees. If you have any questions, please put them in the chat. We'll get those answered. And then, well,
And also,
Dustin,
I'll take the moment to throw up my information. Again, you don't have to work with me to call me. I love chatting markets, and I'm all about just helping producers. So here's my info. If you're watching it later or whatnot, you have questions, feel free to reach out to me too.
while you're looking that up, something that I hear producers talk about doing right now, thanks to the beef unborn calf program, is risk managing a purchase of bred heifers or bred cows by buying those animals and then buying LRP. Could you talk about that strategy a little bit?
Yeah, we actually see this done in both beef and dairy because replacement heifers are extremely expensive in dairy as well, just like they are in beef. So we will have folks that are placing coverage on animals. Again, you can retain them so that they know that they will retain, but because there is such a extreme price right now in the market, and that's what, whether it be their bank note or whatever is written off of, they've got to maintain that asset value. And so rather than risking the price falling and the asset declining as well, they'll place this coverage so that if that does happen, they're reimbursed at the end of the time period for the value of that animal, and then still following that market through. So again, I've seen folks cover up to 3, 4, 5-year-old cows with this. It's not common the older they get, but definitely I've seen this used for replacement heifers a lot lately.
Wow. We talk about using programs in tandem. In theory, could a producer buy the unborn calf insurance on a bred beef cow and then also buy the cull cow insurance? And then once they wean that,
Yeah, that's a great question, and it's the first one you've stumped me with here. Um, there's the one big thing that I would say the insurance companies look at the most is making sure the animals aren't covered on that the same animal isn't covered with multiple different levels of coverage. So my expectation, I would venture to say that because you're covering the unborn calf and not the cow, that you could do that, but I don't want to put my stake in the ground there. So if you're curious about it, let's have a conversation. Give me a ring, and I'll get you that answer in later, Brett. But I think you could, because it's not the same animal. You're covering the embryo, and the live cow. And to give you an idea here, just pulled it up. Let's say, for example, we're looking at 100 head, and you want to do full coverage to make sure that you're getting the best price possible, best floor price possible. You're looking at 100, about $1.25 per head on at the unborn, and that's so if you hold it to the 6 weight. You can also cover a calf once it's born up to a 6 weight, but we'll just assume that somebody did it that way. Unborn coverage there, and then if we take a look at let's say a steer, just because that's a good example. Again, this is for a year out coverage so that we get the highest premium. So we're having an overestimation rather than an underestimation here. You're looking at a $1.20 for per head at the 6 to 1,000 weight, and then if you want to take it to finish weight, So that takes us to about 250, let's call it. And then if we take it to finish weight, and let's just say that again, so that we look at what the highest possible cost right now in the market would be. You're looking at 160. So yep, I was right about that $400 mark is where I had it, and numbers haven't shifted too much from there at the moment. It's a little bit harder to estimate and put an official number on the premium because they do change, and of course you're going to have multiple stages of life of this animal. But if you were to sit here and take a look at that, I mean, you're securing a roughly $4,000 animal right now for $400.
Gotcha. So really about 10% of its value.
Yeah.
Fantastic. I really appreciate you going through and finding the math on that. I think it's been a good discussion. I don't see any more questions in the chat. Colby, did you have any more questions for Dustin?
Dustin, you've done a pretty good job of informing me because I'm going to be honest, I didn't know much about this program coming in here. So thank you.
Of course, Colby, happy to. Hopefully you can tell I love chatting cattle. Most of my life revolves around four-legged animals that move, whether they're black and white or brown, black, white, and a mixture, all of them. So appreciate you having on me. Appreciating you having me on. Excited to see where the future of this AgBiz Insights goes. I'll be watching. And anytime that I can help, please let me know. Also, go Vandals.
Go Vandals. Well, I
Go
appreciate you
Vandals.
being on, and that's a great way to end it. I certainly learned a lot about the changes on the LRP program. Sounds like there's certainly some great opportunities for folks, and certainly worth a look if you're somebody in the livestock sector. So again, thank you to everybody that was here. Really appreciate your time, Dustin, and I think this was a very enlightening session.
Take care.